Let me give you two companies. First company is growing revenue, improving its margins, generating real cash flow, and the balance sheet looks great. Fundamentally, it looks like it's doing everything right. But the stock keeps making lower highs and lower lows. Every time you look at it, it might turn around. Sellers are knocking it right back down. Now, let me give you a second company. It's losing money. It's diluting shareholders. The balance sheet looks like crap, but the stock is going straight up. Which one do you buy? Honestly, this is the question I've been wrestling my whole entire career. I don't trust what the business is telling me, or I don't trust what the chart is telling me exclusively, because I do believe fundamentals matter. I want to know what I'm putting my money into, but I also want to know if that good company could be a terrible stock over a long time, or a lousy company can keep running much longer than anybody would think. So a lot of investors choose one side or the other. The fundamental investors may look at charts and think they're looking at nothing more than astrology with candlesticks. The technical traders may look at financial statements. They might, they don't matter because everything is already reflected in the price. I don't think either one of those answers is complete. I don't think the fundamentals and the charts are answering the same question. They're answering two completely different questions. And by the end of this video, I'm going to give you the three questions I think will bring this all together. What deserves my money? When I should act? How much can I afford to risk? Quick disclaimer, I'm not a financial advisor. This is a video for education and informational purposes only. It's not a recommendation to buy or sell anything. Investing involves risk, including the loss of principal. Please do your own research and make decisions that fit your goals and your risk tolerance. So let's separate the two jobs, beginning with the fundamentals. All right, let's talk about fundamentals. Fundamentals tell me what is actually happening inside the business. Is revenue growing? Are earnings improving? Are margins getting better or worse? Is the company producing real cash flow, or are the reported earnings not actually turning into cash? How much debt does it have? Is the balance sheet strong enough to get through this difficult period? Does the company have some kind of advantage over its competitors that can easily be copied? Does the management make good decisions with their shareholders' money? Those are the kind of things I'm looking at when I decide whether a company deserves my money. Now, here's the problem. A great company is not automatically a great investment at every price, right? Like you you could buy one of the best businesses in the world and still lose money if you paid a ridiculous price for it. The company can report good numbers, grow exactly the way you expected, and the stock can still fall because the market already priced something even better. That doesn't mean the company suddenly become bad. It doesn't mean the stock is too far ahead of the business. It's the opposite can happen too, right? A company may look cheap based on its earnings or book value, but it may be cheap for a very good reason. Revenue could be declining, the debt could be building, cash flow could be getting worse. The entire business could be slowly falling apart. That isn't necessarily an opportunity. Sometimes a cheap stock is just a value trap. So some fundamentals can help me decide whether I'd be willing to own what I um, the company and what I believe the stock might be worth. But they don't tell me exactly when the stock will turn around. And they sure as hell don't guarantee that the stock is cheap and can that you can't get any cheaper, right? This is where a chart becomes useful. So a chart really is just a record of what buyers and sellers have already done. That's it. It shows us a trend. It shows us momentum. It shows us where buyers have stepped in and where sellers have taken control, and where the stock has repeatedly had trouble moving higher or lower. I use these things like support and resistance, moving averages, RSI, MACD, volume profile. But I don't look at any one of these things like I can predict the future. An oversold RSI does not mean the stock has to bounce. A bullish MACD crossover doesn't magically repair a bad company. And support is not some kind of a concrete floor that can never break. These are pieces of evidence. They help me understand what a stock is doing right now, whether the market's beginning to agree with my ideas or not. So if I believe a company is undervalued, but the stock is still in a hard downtrend, I have to respect that. I'm always playing the trend. I may not believe or I may believe I'm right about a company, but if the chart's telling me that I'm early or the market knows something that I haven't figured out yet, that doesn't mean I can never buy it. It just means I start smaller. It may mean that I wait for the stock to stop dropping lower and lower. It may mean that I look for buyers to finally step in before I commit my money. So the chart also helps me identify levels where like my idea might not be working. If I buy near support and that support breaks decisively, I need to know ahead of time what I'm doing to and be able to react to that. Otherwise, I may be really managing position and just hoping it comes back. The chart describes the stock. The fundamentals describe the business. And as all we know, the stock and the business do not always move together. So I want to know whether the research actually supports one side more than the other. And the honest answer is not really. There's been a lot of research done on both fundamental and price momentum. Studies show that inexpensive companies found that financial strength mattered. In other words, if you took a group of stocks that all looked cheap, the financially stronger companies generally did better than the worst ones. Now that makes sense. A stock can be cheap, and it's just not enough. If we still have to separate a potentially undervalued business from a company that may be just simply falling apart. But the research also found that price momentum matters. Stock that has been outperforming often continued outperforming in a period of time. Stocks that have been weak often stayed weak longer than people expected. That doesn't mean momentum continues forever. It means trends can carry useful information. And fighting a strong trend can be like extremely expensive. All right. Researchers have also tested the fundamental value and price momentum together. Historically, combining these two produced a more balanced research than they completely relied upon by each of its own. Now, to be careful about this, what that actually means, it doesn't mean that every low PE stock is a bargain. It doesn't mean that every stock making a new high should be bought. It definitely doesn't mean that every RSI reading, MACD crossover, or line drawn in the chart is going to work. There's no magic indicator here. The research is telling us something much simpler. Information about the business matters. Information contained in the price matters. And those two types of information can be useful at the same time. So you don't think that we need to choose a team. I think we need to understand what each tool is actually designed to do. When we put the fundamentals and the chart together, there are really four possible combinations. Strong fundamentals and a strong chart. The business is performing well and the market is confirming it. This is probably the cleanest situation, but it still doesn't mean that we blindly just buy it. The valuation could be ridiculous, but the stock is extended. It could be sitting right there before earnings. So strong fundamentals and a strong chart gives me better confirmation, but price and risk still matter. So the second thing is strong fundamentals, and a weak chart. This is where good companies may be turning into an opportunity, but it doesn't mean you rush into it today. I may start with smaller positions. I might be doing my dollar cost averaging. I might wait for the stock to stabilize. I might like stage my entries instead of buying everything at once. Or I may sell cash secured puts at a price where I would honestly be comfortable owning the shares. The key word is honestly. I don't just, you know, I'm not going to tell you that a put just be or sell a put just because the premium looks good. I sell because I'm willing to own the company at that strike price. The third is weak fundamentals and a strong chart. Now, this may still be completely valid trade. This can absolutely be valid. Momentum is momentum, but I don't confuse the trade with long term investment. If the business is weak and I'm only there because the chart's working, I want smaller size, defined risk, and a clear exit plan. I know when I entered and why I entered, and I want to know when I have to leave. So the fourth one is weak fundamentals and a weak chart. Why the hell do you need to be involved? Honestly, the business is struggling, the stock is struggling, and there are thousands of other opportunities out there in the market. Unless you're playing it short, you just don't even want to be in that. So, doing nothing is also a decision, by the way. One of the most expensive mistakes people make happens when they buy a weak company as a short term trade. The chart moves against them. They don't, want to take that loss, and suddenly it becomes a long term investment. No, I didn't. It became a losing trade without an exit plan. The opposite happens too. Somebody buys a quality company with 5-year thesis. The stock has an ugly week. They panic and they sell, even though nothing meaningful changed inside the business. Before I enter a position, I need to know what game I'm playing. Is this an investment? Is this a swing trade? Is this options income position? Because the answer is going to change what information that I should be looking at for my trade. This is why I don't believe charts and fundamentals are always equally important. It depends on really what I'm trying to do. If I'm making a long term investment, the fundamentals and valuation should lead. If I'm planning to own a company for 5 years, tomorrow's MACD reading shouldn't really control my entire decision. I want to know whether the company can grow revenue, earnings, and cash flow over time, and whether I'm paying a reasonable price for the future growth. So if I'm making a swing trade, the chart becomes more important. That position may only last a few days or a few weeks. Trend momentum, support, resistance, volume, and the location of my stop can matter more than where I think the business will be in 5 years from now. If I'm selling options for income, I need both, right? I need to know that when I'm selling a cash secured put, I need to remember that I may end up owning this 100 shares here. The chart may help me choose the strike and the timing, but the fundamentals help me decide whether I'm comfortable even owning the stock or if the stock continues falling. So I also need the premium to justify the risk if I'm selling a cash secured put. And if anybody is day trading, immediate price action, liquidity, and volume are probably going to dominate this decision. They're not buying the next 5 years of business. They're only trading the next 15 minutes. The shorter the hold period, the more immediate price behavior matters. The longer the hold period, the more the quality, valuation, and the future cash flow matters. So, why I can like a company and still say not yet? I may love the business, but I hate the current setup. And I can also recognize a strong trade without pretending I want to own a company for the next 10 years. All right. So after looking at this from both sides, this is where I landed. I need to answer three separate questions. What deserves my money? The fundamentals and the valuation help me with that. When should I act? The chart, price levels, momentum, and upcoming catalysts help me answer that. How much can I afford to risk? My position size, my invalidation level, my exit plan, all of that helps me with that answer. So, what, when, how much? Fundamentals decide if I'm willing to own. The chart helps me decide when I'm willing to act. And the risk management decides how wrong I could afford to be. If the fundamentals in the chart agree, that gives me stronger confirmation. But I still have to respect the valuation, the size of the position, and the possibility that I'm wrong. If they disagree, I don't have to force a decision. I could wait. I can go smaller. I can change my entry. I can define my risk, or I could just treat the position as a trade instead of pretending it's an investment. I don't have to buy a stock today just because I like the company. And I don't have to marry a company just because the chart looks really good this week. The goal isn't to choose between becoming a fundamental investor and a technical trader. The goal is to use the right tools for the right job and to understand exactly what kind of position I'm entering before I put my money at risk. Now, I'd love to hear how you would handle this. When the chart and the fundamentals disagree, which one do you usually trust? And has that decision helped you or burned you in the past? Let me know in the comments. If you want practical income investing education built around real decisions, not perfect hindsight, subscribe to Practical Income Investing. We're going to continue building out these fundamental videos, including a complete breakdown of the 7 fundamental principles that I check before buying every stock, and a whole lot more. Thanks for watching. I'll see you in the next one.